Hi. So the file that I'm using for this exercise is linked in the description below. So you might want to open it and work along to follow. So the file has two worksheets. The first one contains instructions and questions. And then the second one contains the worksheets that we are going to be using. So you might want to pause here and read through the instructions that describes the scenario that we are going to be working through. And once you have done that, then you can look at the questions. And to answer the questions, you'll first have to work through these various steps. So let's start with step 1, which requires us to calculate the gross income. Now, remember that Jacob and Maya are filing their taxes jointly as a married couple, right? So we need to add up their incomes to figure out what their joint incomes are. So Jacob earned a $152,000 gross salary, and Mia earned a $74,000 gross salary. So we are going to list that in gross income. Okay, Jacob's salary, okay, it was 152,000. Mia's salary at 74,000. Okay, what other incomes do need to be listed here in gross income? So they made $4,000 in capital gains on stocks, and because these gains were made on stocks that they held for less than a year, they are going to be considered short-term capital gains, and short-term capital gains are taxed at the same rate as their ordinary income. Okay, and because these stocks were held not in their retirement account, remember your investments in your retirement account are not taxed until you retire and withdraw that amount. But these were not held in the retirement account, so they're going to be taxed in the year when the capital gains were realized. So we need to include that in our calculation of gross income. Okay, so that pretty much is their sources of income. Now we can add up their total gross income by using the auto sum function over here, and it adds up, it automatically detects the numerical values above it. Okay, we just make sure that it includes the cells that we want to include, and if we know that it is correct, then we just press enter and it adds up. So their total gross income is $230,000. Step number 2 is to calculate their adjusted gross income. So adjusted gross income is the gross income after making certain deductions for expenses that they have incurred. And these deductions are permitted by law. They're specified by law, and they're called above-the-line deductions. And in class, we learned what those above-the-line deductions are. Okay, and these above-the-line deductions are things such as their contributions to their retirement accounts. So 401k account is a retirement account, so the contribution that Jacob made to it is an above-the-line deduction. So Jacob's contribution to his 401k account, $16,000. Okay, and then Maya's contribution to her retirement account, and her retirement account is called a 403b account, because that's what retirement accounts are called if you work for a non-profit organization, as Mia seems to be doing here. Okay, contribution to her 403b account, and that amount is $11,000. Okay, what else? What else can she deduct above the line? Her health insurance premium. Okay, so their health insurance premium that they pay for their family okay, is deductible above the line. Okay, Jacob's HSA contributions. So HSA is the health savings account. It's an account that you can make contributions to, and those contributions are deductible from your gross income. However, you are limited to spending the amount in these accounts only on healthcare expenses. Okay, so 2,500, it was Jacob's contribution. Mia's contribution was also 2,500. Okay, let's see what else can they deduct above the line. The property taxes and state income taxes and charitable donations are below the line deductions, so we don't deduct them right now. Okay, we've taken care of these above the line deductions, also called adjustments to gross income, and we subtract that from our gross income to arrive at our adjusted gross income. So we're going to insert a formula here to calculate that. We start with the gross income. Somehow that disappeared, so I'm going to redo that. Okay, so the gross income is in this cell, and then I subtract from it the sum of all these above the line deductions or adjustments, and then I press enter. So their adjusted gross income is $189,000. Okay. The next step is to calculate their taxable income from their adjusted gross income. So we start with the adjusted gross income. Okay, I'm just going to refer to the cell that contains my adjusted gross income. And then now we can deduct one of two things. We can deduct the standard deduction, which we are told for married couples in 2020 was $24,800. Okay, so we can deduct this amount, or we can deduct the total of their itemized deductions. So we should choose whichever one is greater, because our goal is to have as low a taxable income as possible, and therefore to pay as little in taxes as possible. So we want the biggest deductions possible. Okay, so what are their total itemized deductions? So I have a little table over here that you can use to tally up their itemized deductions and see what they amount to. Okay, so the first itemized deduction that they are eligible for is for the donation that they made to a 501c3 organization. Okay, so their charitable donation, only donations to 401c3 organizations, 501c3 organizations are tax deductible. Okay, so $4,000. Okay, now the other kind of deductions, okay, the state income taxes and property taxes are part of a group of deductions called SALT. Okay, so SALT stands for state and local taxes, and we need to see how much they add up to, because there's a provision in the law says that you cannot deduct more than $10,000 in SALT. Okay, so let's see. So how much did Jacob pay in state taxes, and how much did Mia pay in state taxes? Okay, so Jacob paid 8,000, Mia paid 3,000. So let's put those numbers there. Okay, what other kind of SALT, that is state and local taxes, did they pay? Well, the property tax is a SALT because it's paid to the local government. Okay, so the property tax they paid on the home is going to be part of SALT, 12,000. Okay, so that pretty much covers their SALT. So how much do their SALT add up to? Let's auto sum it. Okay, this cell selection looks good. So their SALT comes to $23,000. Now they can't deduct the entire $23,000 because in 2020, okay, they were capped at $10,000. So even though they paid $23,000 in SALT, they are going to be only able to deduct $10,000 off it in their itemized deduction. Okay, what other itemized deductions do they are they eligible for? Well, the interest on their home mortgage, okay, is an itemized deduction. So interest on their home loan, and that is $6,000. So that's an itemized deduction. So that pretty much takes care of their itemized deductions. So I'm going to add them up. Okay, make sure that it covers all the cells that we care to add, and it comes to $20,000. Okay, now, so their itemized deduction is $21,000. So it seems that they would be better off taking the standard deduction rather than itemized deduction because it is greater. So we're going to take the standard deduction for them. We're going to start with their adjusted gross income and subtract from it the amount of standard deduction allowed by law in 2020, which is $24,800. And then if we take the standard deduction, we can't take itemized deductions because we got to choose between the two. Okay, so their taxable income is $164,200, $164,200. Okay, and this is the income that they'll pay tax on. Okay, this is an important number. We need to keep that number in mind. Okay, now the next step is to calculate the tax liability. Okay, now we do that in several steps. First, we have to use the tax schedule for calculating their base tax liability. And we talked in class about the tax schedule and how to read it and how to use it. Basically, the way the tax schedule works is that it divides your taxable income into various portions and then taxes the different portions at different rates. Okay, so the first portion is your income from $0 to the first $19,750. Okay, also called the 10% tax bracket. And so we take some of their taxable income and pour it into this tax bracket. So how much of their income is going to fit into this first tax bracket? Okay, well, it's going to cover the entire tax bracket because their taxable income is more than $19,750. Okay, it's going to fill it up entirely. And how many dollars are going to be portioned in this tax bracket? Well, the difference between the upper limit and the lower limit. So we're going to find the difference between the upper limit and the lower limit. So I subtract the lower limit from the upper limit, inserting this formula. And so $19,750 of their income falls within this bracket. Okay, now we take the remaining taxable income and pour it into the second bracket, the 12% bracket. Okay, and that is their income that goes from $19,751 to $80,250. So how much of their taxable income is going to fall in this bracket? Well, first of all, we need to recognize that their taxable income is going to fill this taxable bracket entirely because their taxable income exceeds the upper limit of this range. Okay, so the amount of tax dollars, the taxable income that's going to fall in this tax bracket is the lower limit minus the upper limit minus the lower limit. So $60,499 of their taxable income is going to fall into this second bracket. Well, they're going to have more taxable income left over to pour into the next bracket because their taxable income exceeds the upper limit of this tax bracket. So how much of their income is going to be portioned into this third tax bracket, which is taxed at 22%? Okay, well, is it going to be $80,251 all the way to $171,050? Well, no, because their income tops out at $164,200. So the amount of their income that's going to go in this bracket is $80,251 to where their income ends, which is $164,200. Okay, so equal to 164,000 minus the lower limit of this tax bracket. So $83,949 of their taxable income goes in this tax bracket. And now we have portioned off all of their taxable income into the various tax brackets. Now it's time to calculate the tax that they're going to owe for each portion of their income. So the portion of the income in the first tax bracket is going to be taxed at 10%. So we take the income in this tax bracket and multiply it by the rate at which the income is taxed, 10%. Okay, so similarly, okay, we're going to take the income that's in the next tax bracket and multiply it by the rate at which it is taxed. And we do the same for the next tax bracket. Okay, so this is the income tax that they owe on the three different portions of their taxable income that fall into these three different tax brackets. And if we add these up, then we get their base tax liability. So I use the auto sum function and make sure the sum function includes all the cells that I wanted to add up. So their federal tax liability is $27,703. $27,703. Okay, now we need to apply federal tax credits. You'll recall that tax credits are something that are granted by tax law. There are hundreds of different kinds of tax credits, and you have to take tax credits that you are eligible for, and we are told that the Hudsons are eligible for the following tax credits. So they're eligible for a child and dependent care tax credit equal to $2,000 for the daycare expenses they incurred for their youngest child. Okay, so to $2,000. Okay, so we're going to add those up. Okay, we're going to add up $2,000 plus what else? Okay, then they have a child tax credit equal to $3,600 for each child under the age of 6. Now they have one child under the age of 6. Okay, so they're going to be able to take a $3,600 tax credit for that. And they have a $3,000 tax credit for each child between the ages of 7 and 17. So they have 2 children between the ages of 7 and 17. So they're going to be able to take a tax credit of $3,000 for each. So they're going to be able to take a total of $6,000 in tax credits for those 2 children. Plus, what else? Okay, so they installed a solar system on their home to generate electricity. Okay, and they get a tax credit equal to $1,000 for it. Okay, so that is a tax credit we need to add up. So they are going to be able to take tax credits equal to $12,600. Okay, so the way that the tax credits work is they reduce your tax liability dollar for dollar. So to calculate their final tax liability, we subtract the tax credits from their base tax liability. Okay, so we take the base tax liability, subtract from it the tax credits they're eligible for, and so their federal tax liability, okay, is $15,103. Okay, pretty good. They've managed to reduce their tax liability quite a bit, okay, due to these multiple tax credits that they are eligible for. Okay, the final step is to calculate the amount that they must send to the IRS or receive as a refund. So we start with their tax liability, okay, and then we need to subtract the amount that they have already paid as taxes throughout the year by having it deducted from their paycheck. So we talked in class about federal tax withholding, how the law requires all employers to estimate taxes for their employees and deduct it from their paycheck and send it to the IRS on their behalf. So when you file your taxes, you need to claim credit for it. Okay, those are taxes that you have prepaid. So how much taxes have they already prepaid? Okay, so we are told that Jacob's and Mia's employers have withheld the following amounts from their 2020 paychecks as federal income taxes. In case of Jacob, $26,000. In case of Maya, $15,000. Okay, so they have already paid $26,000 plus $15,000 as federal income taxes. So they've already paid $41,000 in income taxes that year. But when they do their taxes, they discovered that they actually owe only $15,103 in federal income taxes that year, which means that they have overpaid their taxes, right? And if you have overpaid the taxes, if you paid more than you owe at the end of the year, then you should get a refund for the amount that you overpaid. So what is the amount that they have overpaid? Well, what is the difference between what they paid and what they actually owe? It's going to be what they paid minus what they owe, which is $25,896.34. So they're going to get a nice big fat tax refund check. Okay, now having worked through these worksheet, we are ready to answer the questions in the instructions and questions sheet. What is the Hudson's marginal tax rate? Well, the marginal tax rate, you'll recall, is the tax rate of your last dollar of taxable income. So the last dollar of taxable income falls in the 22% tax bracket. Okay, it was taxed at 22%. And so that is their marginal tax rate. Okay, what is the Hudson's average tax rate? So you'll recall that average tax rate is your tax liability divided by your taxable income, okay, expressed as a percentage. So let's convert this into a percentage format and insert the formula for calculating it. Okay, so what is their tax liability? Their tax liability is 15,103. So I select that cell, okay, and then I divide it by their taxable income. And then I press enter, and it tells me that their average tax rate is 9%. If I increase the decimal points, it's 9.2%. Okay, so they paid 9.2% of their taxable income as federal income taxes. That's a pretty good tax rate. If you're paying only single-digit percent as your federal income tax, you're getting away with paying very little tax. And the reason that the Hudsons were able to do that is because they had all these tax credits, right? And they also had all these deductions. Okay, so good for them. Okay, now if Maya's annual salary were $100 higher, how much more would their tax liability be? So one way to do that is to redo these calculations, but giving Maya a $100 raise. So instead of $74,000, her income would be $74,100, and see how these numbers change. Okay, you can definitely do that, but there's a shortcut, okay, and that is to see how it would affect their taxable income. Well, the taxable income would go up by $100, and then ask yourself, in what tax bracket would that additional $100 be? Well, it would be in the last tax bracket that their taxable income fell into, 22%. So that additional $100 would be taxed at 22%. Okay, so how much more would they pay in taxes? Well, 22% of additional $100 is $22. So their tax liability would have been $22 higher. And this is why we need to know our marginal tax rate, because it tells us, like, if we had additional taxable income, okay, what percentage of that additional income we would pay in federal income taxes. Would their tax liability be higher or lower if they did not own a home but rent instead? So how would their taxes change if they didn't own a home? Okay, well, they wouldn't have property taxes. Okay, you only pay property tax if you own a property. So their SALT deductions would be lower, okay? But it wouldn't affect any of their calculations because they're not taking itemized deductions anyway. Okay, they wouldn't have home interest loan either, okay, which would even further reduce their itemized deductions, which still won't change the fact that they are better off taking the standard deduction because it is the bigger amount, right? So not having interest on their home loan, not paying property taxes, reduces their itemized deductions and still leaves standard deduction as their best option. So not having a home won't affect this part, okay? It won't affect their taxable income. What it would probably affect, though, is the fact that they wouldn't have installed solar panels on their home if they hadn't owned the home. So this tax credit equal to $1,000 for the expenses they installed the solar photovoltaic system in their home. Okay, they wouldn't have incurred this expense and they wouldn't have a tax credit for it. Okay, so their tax credit would be lower by $1,000. Okay, which means their tax liability would be higher by $1,000. Okay, so their tax liability would be $1,000 more. Okay. Oh. Greater. I'm just going to expand this so that we can see it. Okay. How much higher or lower? It would be $1,000 higher. Would their tax liability be higher or lower if they had given $100 more in charitable donations? So let's see. If they had given $100 more in charitable donations, so their itemized deduction would be $100 bigger. So instead of the charitable donation being $4,000, it would be $4,100. The total itemized deduction would be $20,100. But the total itemized deduction would still be lower than standard deduction, so they would still end up taking the standard deduction. Okay, so it won't change their taxable income at all. Okay, so it would have no effect on their taxes. No effect. Okay, how much higher or lower? $0. Okay, and that's how you do this exercise.